recognize that there's some facts I may not know as well as others, and people are certainly free to correct me. And as you'll see, this is a work in progress. In fact, it was just finished. One of my predecessors was speaking. So you should regard it as sort of notes, research notes. Let's see. I realize this is me. So,
But I want you to
where's the delay button? Where is it?
Lower bar.
Lower bar to the left.
no, come.
I'll just speak fast. Great, okay. PowerPoint's new to me. So I'm going to speak about this question. Did the LTROs really cause bond yields to decline? The LTRO, people have heard, not everyone knows exactly what it is. It's a financing provided by the ECB on a collateralized basis. There's a variation margin, which means if there's a loss of security, a bank has to make up the loss. It's floating rate, it's not fixed rate. The haircut is not fixed. We'll talk about that a little bit later. That's a misconception that it's fixed. It makes a big difference. We don't have to read these quotes, but I think you've heard from speakers throughout the conference about the importance of the LTRO. I think Paul Krugman talked about it. The gist of it is maybe captured in the last quote, which is there was an upcoming wall of funding refinancing the banks by their outstanding debt in the first quarter of 2012, or in the whole of 2012, and the bank's inability to accommodate this would have led to bank failures and fire sales and so on. So I'll talk about the LTRO itself a little bit later. First I want to talk about the story of Italy and its stress period, and then we'll talk about whether the LTRO has quite as much content mechanically as people think. So these graphs are, the white one is Italy and the orange one is Spain. Spain is just a reference. This is the spread for Germany. It's a 3-year bonds. So the idea here is to show sort of the rise in stress. This is August. This is the end of August. This is late September, October, and this is November all the way to November 30th. So this is characterized by a government described by some as buffoonish, but certainly not serious, with scandals. Starting in August, they have reform packages that are agreed, then disagreed, adopted, unadopted, agreements collapse, scandals erupt, and so on. I think the story is somewhat well known. So that starts to become acute for reasons that we'll not get into in early November. There's a cohesion problem in the parliament. You can see this happens in late October. In addition, contempt, which is so this famous incident. They were expressing contempt when asked about whether the Berlusconi government had taken serious measures. This is also not a good sign. Then on November 8th, Berlusconi, who was the prime minister, resigns, but maybe he's not resigning. After he finally resigns, he might return, but he might not return, and that goes on for weeks. There are also broad-based calls for unlimited ECB buying, which are going on in November. Which the ECB resists. So these are very broad-based, and they're very, very powerfully stated. The ECB is the only alternative to solve this bad equilibrium, whatever it is. Then parties delay support for Berlusconi. He's confirmed here, but parties delay their support for him because voting for the confirmation doesn't quite vote for his policies. Yields go up, and then yields go up. All of a sudden, he gets support, and then he announces at the end of this period, November 30th, that he's going to introduce serious budget reforms the next Monday, which is 5 days later.
Monty.
Monty. Thank you. So that, in fact, they move it to, well, anyway, so they on December 4th, they detail their, by the way, the timer's not moving.
We're lucky.
Just reset it where you think's right. Anyway, so on December 4th, he announces that there are going to be proposed reforms. Here's the
Nessuna riforma
announcement.
pensionistica dà nell'anno successivo alla sua introduzione o nell'anno della sua introduzione risparmi, perché il sistema pensionistico è un meccanismo lungo tra le generazioni e allora abbiamo dovuto, e questo sì che ci è costato anche psicologicamente, chiedere
Che stesse per dire sacrificio, come avete capito.
So in reaction to this,
Interpretare il sacrificio così efficacemente trasmesso dal ministro Fornero
he's talking about
riguarda la deindicizzazione delle
there's the market reaction. Over here. So here's where yields go. LTRO hasn't been announced yet. So my point with that is not to claim that, make claims about Italy's level of spending, but the changes are hard. This government is regarded as serious, and that, well, is regarded as serious. I think it's well known. Then the LTRO is introduced, right here, actually, right here. And then we have the following course of stuff. Okay. And now I'm going to talk about the LTRO in a second, but first I just want to comment on what happened here in terms of the ECB. The ECB, what's that? Yes. The ECB, well, first of all, high rates create a tendency for governments to fix things. First of all, because they get a lot of political capital, and second, because they feel like fixing things, because things are bad. The ECB, in fact, bought very little compared to what you would expect during this kind of yield crisis. So my personal view is that this was magnificent inaction. It's unappreciated and it was incredible. Now let's talk about the mechanics of the LTRO. Oh, before I do that, this is what this is the green line, in case, for people who are interested in banks as opposed to countries, the green line is an Italian bank, CDS, and here's where the LTRO's announced, and here's where the budget's announced, and so on. Okay. So, I guess, first thing I want to talk about here is, let's remember, it's a lot of stuff. Reading it's not going to help probably, but there's a lot of emphasis on the financing, wall of funding, and so on coming up acutely, and that's what the three-year LTRO solved. But people forgot something, which is that on October 6th, the ECB announced a 13-month LTRO, which would start on exactly the same date as the three-year LTRO ended up starting. Okay, so I suppose I have the documentation if you want to look at it at lunch. The bottom line is that there was already in place a 13-month LTRO starting on exactly the same date as a three-year LTRO. So all the stories about the funding problem, acute funding problems that would happen in the first quarter of 2012 or any time in 2012 are hard to make sense of, and I think sort of deducibly false. Next, the MRO, which was already described, is sort of like the LTRO, but it's weekly. It's the basic instrument of monetary policy, and it gets its haircuts, which I'm not going to define, so you can ask me lunch, but it's an important feature of them, from something called a single list. The LTRO, the three-year LTRO, is exactly the same as the MRO in its haircut. It gets its haircut also from the single list, and even if the LTRO has already started, the single list is checked daily, and if the single list changes for haircuts for the weekly MRO, it also changes for the already existing 13-month or three-year LTRO. And also the three-year LTRO's rate floats off the MRO's rate. This is sort of important. I'll get to it. So one question is, well, how is just doing an MRO over and over different from doing an LTRO? And the answer is, well, maybe they're not different. since the MROs, we learned, it was full allocation since 2008, and it was guaranteed to be so since 2012. For as long as it was going to be full allocation, which means you can get as much as you want, there's absolutely no difference between the 3-year LTRO or the 13-month LTRO or any LTRO and the 1-year and the MRO. However, and of course, if there had been no 3-year LTRO, chances are people wouldn't be, well, anyway, it could be that there's some case the MRO could get a fixed allocation instead of floating allocation. This is, of course, the risk, and I'm not going to go through all the details, but since the LTRO floats off the MRO in terms of the rate, basically you can get a small difference between the LTRO rate and the MRO rate, and it's quantifiable and it's tiny. It would be a subsidy of $1 billion or $2 billion a year, only if the MRO becomes fixed allocation. So it would be surprising if putting aside my argument about the 13-month LTRO, it would be surprising if the MRO changed the course of European history because it's a tiny subsidy. If the 3-year LTRO, differentially from the MRO, which was unlimited since 2008, changed the course of European history. In addition, by the way, the LTRO rate, let's get that. Okay. Fine. For those of you who think in terms of repo and think the LTRO is a long-term repo, it's not compared to the days. And these are just documents explaining, going through some of this stuff. Neat. Okay. Now, so what is the harm in having 3-year LTRO? I certainly have no problem with central banks providing liquidity. So what are some of the problems? However, if it's not necessary, maybe. In any event, here's some of the problems. The first one is the subordination of unsecured debt. You can get a spiral out of this. So when liquidity is provided, the subordinated debt of banks is these unsecured debt of banks becomes subordinated. The more liquidity is provided, the more it becomes subordinated, and then you get a spiral, which is the Martin-Schmalz spiral coming out of that. You can explain that at lunch. The banks also need to fund their losses. So this sounds like a small matter, but when I last looked, all Spain's purchases since the LTRO were underwater. All Spanish banks rather purchased were underwater, so they'd actually have to come up with more cash, and the mark-to-market equity is lower. So this is a risk. Why did banks take a lot? So there's a small potential in the future yield advantage. Also, there's NCB nagging. This is anecdotal, but it's anecdotal from so many people. Everyone you ask who seems to know a bank has a story about NCBs trying to get banks to take up LTRO. That is one explanation for the high rate. There's also reverse stigma, which grows since December. The idea here is that the board of a bank will say to the CFO, "We heard about this wonderful 3-year LTRO stuff, but we don't have any," and so the CFO sort of is pressured both by that and by the central bank trying to get them to take some, that they take more. And it's surprising that at the end of February, where stress is low, the net uptake, adjusted for some stuff, is 75% larger than it was the first time. It could be additional credit claims, but they're actually quite small, so it doesn't prove anything, but it's instructive. Comment on bond buying by banks. Italian banks started, so there's an idea, separate from the wall of preventing the financial collapse of banks because of the refunding, which is that banks were induced to buy Italian sovereign debt, rather, and this has made a big difference. So first of all, you have to keep in mind that we have to remember there's a big world out there. Italian banks started with only 15% of outstanding Italian bonds. So there's a lot of people to sell to them. The standard market reaction to news of slow-moving non-economic demand, which in this case would be NCB nagging, is to rise before it front-runs the slow-moving demand and then sell to it, leading to no change in prices. From the numbers, best I can tell right now, it looks like the holders of Italian bonds, except for banks, sold significantly more debt than Italy itself net sold in these 4 months. And that doesn't even count shorting, so the price is too high because there's non-economic demand goes to shorting. And this whole thing feels like it might have pushed banks into bond positions, which means we get more of what Marx calls the diabolical loop problem, which is the co-evolution of sovereigns and banks, the feedback. Okay. another way to use the fact that there was an LTRO announced on October 6th to sort of think about what happened. So, given, there were actually 2 LTROs announced on October 6th. Keeping in mind the 3-year LTRO was announced December 8th, which is here, as you know, for for settlement December 22nd. So here we're looking at a 1-year bond in blue. So 1-year bond is LTRO protected starting on October 6th. And there's actually an LTRO that settles, there's a 1-year LTRO that settles on October 27th. It provides full coverage for this bond. Yet it goes to higher levels than any other bond, any other Italian bond, even though it's susceptible to the enormous arbitrage of banks buying this and making all that spread. And it also declines more than any other maturity, and it also declines somewhat monotonically. So it tells a story that has nothing to do with the 3-year LTRO, which was announced later, which is a simple story of probability of near-term default. And that's how I would interpret that, and I think it fits the news facts. Another little way to take a look at what's going on is this is a succession of yield curves, the lowest one in white being the Italian yield curve, I think, at the start of February. This is the 3-year point, and that's the 4-year point. You would expect, if there were a differential effect in 3-year LTRO, that would be very, very steep. In fact, it's sort of oddly shallow. Amusing fact is that there is a private repo market, as it turns out. Through January, this is the size of the private repo market is in blue, and the ECB repo is in green. An amusing fact, according to ECB statistics, as well as we can interpret them, the private repo market in December declined almost exactly as much as the net add of the LTRO. It could be crowding out, it could be, just rushing in because the repo market disappeared. Although it didn't disappear in November when stress was very high. So this is a list of other claims about the LTRO and its mechanism for action. I'll just talk about this one, which is not really the LTRO, but dollar funding, which was announced on November 30th. So what was actually announced was a 50 basis point reduction in available dollar funding for non-dollar collateral. In the first of the monthly 3-month auctions that was held after this announcement of price cut, $50 billion of lending was auctioned off, so with an approximate benefit of $65 million for this monthly auction. So that is not a large number. And here's the documentation of that. So what is the cost of getting the LTRO story wrong? I mean, I certainly have no problem with central bank funding, but why do I care that this may be misunderstood? The first reason is that it undermines reform. The misattribution of the cause of the rate decline saps governments of energy and political capital. They do all this hard work, and then they read in the newspaper that they really didn't do anything, and it was just a central bank waving its magic wand. And it makes it hard. To the extent that it is believed, either by governments or by people, it undermines reform. And the ECB can then later say, we urge you to reform, but it's not that moving, especially when yields have come down and it's misattributed. It raises the probability of doing this again to solve a future stress problem. If it wasn't the solution, it won't be the solution next time, and that's dangerous. It causes unnecessary intra-Euro system discord. So there's some central banks in the Euro system which have a reasonable conservation of happiness principle. If things are good now, we're going to pay for it later. So they are, it wouldn't be surprising if the 3-year LTRO didn't bother them nearly as much as it wouldn't have bothered it nearly as much if it hadn't been attributed, if all this success hadn't been attributed to it. But since it was, it causes concern. Of course, it's not good for central bank credibility. In addition, there are risks from the existence of too much of this financing, not just from misunderstanding it. One risk is it intensifies the diabolical loop, which I described already. The other is you get a system-wide subordination spiral, which I mentioned, the Schmaltz spiral. Systemic margin spiral, which Marcus has described. It tends to raise target 2, which has its own run dynamics. And I just asked the question, has this action reduced or raised tail risk? Why was I initially interested in this topic? Who cares? I mean, you know what? I don't know. I didn't know these details before researching it. And the reason is that central bank observations of liquidity as a problem or solution are sometimes incorrect. And so I was attracted to this question. Central banks are subject to Maslow's law of the instrument with respect to liquidity. I'm now going to give you my glossary of things I learned, terms I learned in researching this piece. Maslow's law of the instrument comes from 1966. Here it is. If all you have is a hammer, then everything tends to look like a nail.
I had a hammer in the morning, I had a hammer in the evening.
Next. Market market. This is the doctrine that pessimistic market prices are never related to fundamentals because the bad equilibrium liquidity self-fulfilling prophecy spiral. Practitioners are called spirologists. And then I learned about the post hoc fallacy. Post hoc ergo propter hoc, the logical fallacy that succession applies causation. As you see here, if the LTRO happened here, then we would see succession applies causation fallacy, and maybe we believe it. On the other hand, here we have that this enormous drop happens, and then we do the action, and then we say causation is implied. So we have a new fallacy, which is anti-hoc, ergo propter hoc, preceding implies causation, and you can email me, Jacob, at anti-hoc.